Sup guys, Christos here. In today's video, I'm going to be sharing 5 red flags that every single investor should be looking out for, whether that's looking at new companies to invest into or even taking a look at the companies that you already own. Knowing about these red flags and catching them early on can literally be the difference between making great money in the stock market and simply losing a good old chunk of it. So let's not waste any more time and let's jump straight in. Okay, so red flag number 1 when it comes to investing into stocks is when a company is producing unstable earnings. In terms of what you should be looking for, most people say that a healthy growth rate for an established company is anything between 15 to 25% annually. However, a lot of the companies that I invest into are high growth companies that are typically quite new to the stock market and they are expanding extremely fast. So the number I would typically look at, instead of being around the 15 to 25%, is actually more around that 50% mark in terms of growth every single year. Now, when it comes to taking a look at a perfect example of what I think is a red flag in a company in terms of its inconsistent revenues, I think the best example that I could come up with is taking a look at Peloton stock right here. Now, if we actually take a look at the annual incomes for Peloton, if we actually take a look at 2021, it actually says that they did around $4 billion in revenue for that year. However, one thing that I found really interesting is if we actually dive into the quarterly revenues, and as you can see at the start of 2021 or even at the back end of 2020, things were pretty good. We went from 1 billion in revenue to 1.2 billion in revenue, and then as you can see, what actually started to happen throughout the middle of this year, COVID restrictions actually started to ease off, and what actually then happened was the demand to having Peloton bikes in your home, because everyone was starting to go out to the gym again, was becoming a lot less apparent. And as you can see, the revenue did reflect in this. We went from 1.2 billion down to roughly 936 million in the June update. And then in the September update, they reported revenue figures of even lower. Now, to me, whilst it looks from an annual point of view, it looks really good, right? We see that year on year, it's improved massively. A lot of that we need to understand that a lot of it came from the demand over COVID and all of that stuff. And now we can see those restrictions now easing off. We can actually see that Peloton isn't doing as good as a business. So from afar, Peloton looks like maybe a really good buy. But if we actually take a look at their revenue figures, things look like it's a declining business at the moment. So that is red flag number 1. Now, moving on to red flag number 2, and that is going to be the consistent increase in a company's debt to equity ratio. So what is this? Basically, when you run a company, you of course are going to need cash. Now, in an ideal world, of course, a company would make some money, then reinvest those profits to obviously grow the business. However, in most cases, this is going to take a lot longer in terms of a process to actually get that money back in. And in most cases, what companies tend to do is they will take on debt to facilitate growing their businesses. Now, as investors, we of course need to understand that something like this is perfectly fine to do, and most companies do it. However, we need to, number 1, understand why they are taking on more debt. And in most cases, it's of course to grow their business. And then number 2, we need to see how the company is servicing that debt in the long term. Now, the figure that we're going to be looking at here as a measurement device is the debt to equity ratio. And what we want to be seeing is either that company maintaining a consistent level of debt to equity ratio, or in best case scenarios, improving and narrowing that percentage down on a quarterly basis. Now, a really good example of a company that I invest into that has done this really well is Corsair. If we take a look over here, let me just switch my face to the other side. And what you can see with Corsair here is that actually from 2017 through to around 2020, what we actually saw was their debt to equity ratio constantly increasing. Now, this is probably because they were taking on more debt to grow their business, to buy more units, to buy more chips, to build more components for their customers. However, what we can actually see is that in mid of 2020 and more so over in 2021, we can actually see that company now servicing that debt and seeing that debt to equity ratio start to come down. So as we can see, we peaked at around 233.3% debt to equity ratio. However, now coming down, we are now down to 46.3% in terms of their debt to equity ratio. This is a really good sign. Now, if this company was to continue increasing this over year-on-year basis, this would be a worrying sign for this company because they are simply taking on more debt that they do have to pay off eventually, and this isn't going to fare very well on their balance sheet. So that is my second red flag, making sure that the company's debt to equity ratio is improving, not increasing year on year. Now, moving on to red flag number 3, and that is the multiple insiders selling all of their shares at once. However, with this one, let's not jump the gun too quickly and get this confused with just maybe 1 or 2 people selling their shares, because one thing that you will notice a lot, especially if a stock has risen significantly over maybe a couple of weeks, is that maybe a high figure or director of a company will sell a few of their shares. All of this is completely perfectly normal. We saw Elon Musk actually do it the other week. He actually did it quite tactically by running a Twitter poll, but that's just very much Elon Musk. But one thing that they are simply doing is what we are doing. They are just simply following the good old model of buying low and selling high strategy. Now, this is completely fine when these things happen. It happens all the time. However, if you start to notice multiple insiders start to sell their stocks all at once, especially when there has been really no real price change or any kind of activity with the stock, this could be another major red flag. Because at the end of the day, this is the way I put it. If the people running the company who knows the insides and outs of that business don't believe the business is worth its current share price, then the likelihood is it isn't, and at some point it's definitely going to correct itself. On the flip side, however, one thing to note is that the opposite could also be a good indicator for buying. So let's say you started to see a bunch of insiders buying up all the shares at once. This could be an indication that they believe, based on performance and future prospects of the stock, it would be a good idea to start investing. Now, one example that I spoke about in a recent video is DraftKings over here, and one of the reasons why I said I wasn't too worried about its recent stock crash is because what I managed to actually start seeing and noticing is a lot of the higher figures at DraftKings starting to buy those shares at that valuation. So as you can see here, on the 19th, 18th and 16th of November, which is a very short time frame, we saw Stephen Murray, Woodrow Levin, and Harry Sloan all buy significant quantities of shares in DraftKings at around that $36 mark. Now, the DraftKings did actually drop a little bit further from there, but what that really tells me that the insiders, the people that know this business more than anyone out there, thought this valuation is way too low for this company, and we expect this company's share price to go up in the short to near term future. So this is a really good sign. However, if you start to see multiple insiders, especially the CEO, start to sell off all of a sudden, especially when there's been no movement or no news about that company, this could be a major red flag that there could be some bad news on the horizon. Now, if you wanted to find out the different insider transactions for a company, this information is all over the internet. I personally use this tool right here called Simply Wall Street that I think displays it quite nicely, as you can see. However, pretty much any reputable stock site like Yahoo Finance, for example, will have a section that displays insider transactions that have taken place. Now, the next red flag to watch out for, and I guess this one's a little bit similar to the previous one we just spoke about, is to look out for any abrupt change in the company's management team. Now, of course, just like insider trading, changes within a business are completely normal, and these things happen all the time. You could have someone retiring, maybe someone announce that they are going to be stepping down in the future, but one thing I tend to look out for are the more unexplained departures, or maybe the even multiple unexplained departures. Something like this happening could mean that they are no longer on board with the company's vision going forward. There could be a big fallout, or it could just simply be coincidence. However, I think that if you start to see this and there isn't really any explanation behind it, and maybe the person hasn't come out and said anything, this could be a major red flag for the company. My top tip with this one is that if you are holding a stock, always be checking on the company's investor relations page and financial news outlets, because at the end of the day, it is by law that these public companies have to inform their investors when any person or significant control either joins or leaves the business. So you should never miss anything like this, especially if you are just checking on these different news outlets every single week. Now, moving on to the next red flag, and I think this one could potentially split opinions a bit, but one I think definitely does come with some significant warning signs behind it, and that is when a company's dividend yield gets a little bit too high. Now, for those that do not know what dividend yield is, it's basically the ratio in which a company will pay you back money in relation to its stock price every single year. So, for example, if a company's stock price was, let's say, £100 and they paid a dividend of £1 a year, their dividend yield would be 1%. However, let's say the stock was to go up, and let's say the company decided to keep the dividend payout completely the same, the dividend yield would then be at 0.5%. So knowing this is why I think a high dividend yield could actually be a bad sign and a potential red flag. Because first off, if you find a company that is paying an abnormally high dividend, this couldn't just be because they are a generous company and they want to give their investors back lots of money. This could simply mean that their stock price has gone down so much recently that the dividend just simply looks better. However, in most cases, what companies would do is either lower or maybe even stop their dividends in a bid to bring more cash in to help the business improve. But if the company isn't doing this, I think this could be a major red flag. Now, a great example of a company that actually stopped their dividend in a bid to obviously help them survive and actually potentially grow their business is in fact Disney, who, as you can see, actually paid their last dividend out to their investors on January the 16th, 2020. And basically what they did here was, number one, they wanted to use that money to obviously expand their media empire. However, one thing that I probably took a guess at is that they stopped the dividend to obviously help them survive the COVID-19 pandemic, where a lot of their parks were shut. But nonetheless, this is a really good example of a stock price that maybe has gone down a little bit over the course of a period of time, and the business has then taken a proactive step to actually cut the dividend to their investors for the short term, maybe for longer term gains. And that is red flag number 5. Look out for those companies that have those exceptionally high dividend yields. Now, when I actually say high, normally what I say is anything 5 or 6% upwards. Now, the company could just be a really generous company paying a really good dividend as an incentive to invest into their company. However, the one thing that you'll have to do is actually investigate as to why this dividend is actually so high. Do not just take the dividend yield as a really good thing to invest into a company. It could actually be a red flag. So I hope you got some value from this video. Of course, all the things that I talk about in all of my videos is just my own opinion, and it should not be taken as financial advice. But if you did find some value from the video, please do drop it a like and maybe leave me a comment down below. But having said that, guys, I hope you enjoyed the video, and I will catch you in the next one. Take care.